Hey, everybody. I'm going to talk about a company that, despite a pending commercial real estate crisis in the office industry, looks like a very good long term investment. Before we do, please click subscribe to my channel if you haven't already, and take a minute to check out the link you see on your screen for a message from my sponsor, The Motley Fool. It's the best way to support this work that I'm doing, so please check it out. You'll get the top 10 stocks to buy right now. So, one company that I followed for a long time is called Empire State Realty Trust, or ESRT. They're the owner of the Empire State Building and a portfolio of mostly office, but some residential real estate, and predominantly in Manhattan and the surrounding area. So there's a lot of talk about a coming commercial real estate crisis, particularly in the office industry. And to be fair, there are some good reasons people are saying that. We're already starting to see a lot of office owners default on their loans. The problem essentially was that one, remote work has made it so companies don't need as much office space anymore as a whole. And number two, a lot of office buildings were purchased at lofty valuations and with very low interest rate financing. Now, a lot of that low interest financing is coming due over the next few years. And unlike with residential mortgages, commercial loans are generally interest only and have to be refinanced as they expire. So if office valuations have dropped considerably and interest rates have risen, banks aren't going to want to refinance this debt, so a lot of offices are going to default. Empire State isn't just any other office real estate company, and I think that makes it a great long-term investment opportunity. So the company just reported its second quarter results, so let's take a quick look. And this might surprise a lot of people who are very pessimistic on the office industry. Empire State's Manhattan office portfolio is now 91.6% leased. That is over 3 percentage points more than a year ago. It's up 90 basis points just over the past quarter. Its total portfolio is more than 90% leased, and the multifamily is a very strong point. It's about 97.4% leased. The same store net operating income Empire State's getting from its properties is up 1.1% year over year. Not a giant growth rate, but considering that everyone's calling for an office crisis, that's pretty good. One of the things that makes this company unique is that they own and operate the observatory on top of the Empire State Building. And this is, to put it mildly, just a cash machine business. It's a very small percentage of the company's square footage, but makes up a lot of its revenue. Something like 1/6 of its revenue comes from the observatory, and it's just 2 or 3% of the company's total square foot. So the observatory was essentially shut down during the pandemic. It's been coming back very slowly, and this is the first quarter that I've seen where it's up to better than pre-COVID levels in terms of revenue. It saw 16% more visitors in the second quarter than it did a year ago, and it's now making 101% of its pre-pandemic revenue. So it's actually surpassed pre-pandemic levels. This is very high margin revenue. It doesn't cost the company a lot to generate, and it's a part of the business that should get much better over the next couple of years. Empire State has a lot of financial flexibility, unlike a lot of office owners. It has $315 million in cash, has an $850 million untapped credit line. It has no debt maturities, no debt coming due until November of 2024. The average remaining duration on its debt is 5.9 years. So it's not in the same boat as a lot of office REITs. And it's seen very strong leasing activity. And in fact, it actually raised its full year guidance at the midpoint of its current FFO guidance, which is the real estate version of earnings. It's trading for about a 10x multiple. So that's a very attractive valuation, especially if the company can avoid a lot of the office drama that we're seeing elsewhere in the market, which it looks like it is. Occupancy staying very high, average rental rates are staying very high. That should also contribute to the valuations of the property staying very high. It's worth keeping an eye on as we get close to that. I mentioned debt starts coming due November 2024. If interest rates are staying very elevated then and the offices aren't doing well, it could become a problem, but I don't foresee that happening. The market clearly agrees with me. The stock's up about 8% since it reported those earnings, and it still trades for a big discount to its net asset value. So this is one that I own a lot of, and I don't plan on changing that anytime soon. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.